So I'm going to give you a gentle introduction as to how to research funds over the next 20 minutes, what are the options, how should you think about this, and this should hopefully set the scene for then the 5 fantastic fund managers that you'll hear from after me. So I'm going to talk through the different options that are available for investing. I'm going to talk a little bit about active and passive investing. I'm also going to comment on investor psychology and some of the common mistakes that people make, and that'll include myself in that, and indeed the fund managers you hear from today, and indeed every investor out there. So you won't be alone if you make some of these mistakes. Nobody is perfect when it comes to investing. I'm just going to give a brief comment on current market volatility. I'm sure some of the sessions will get into that a little bit as well after me, but I want to talk specifically about how you manage in times like this. And I'll just finish with how AJ Bell can help you before handing over to James at Troy. So a little bit of, and I'm conscious there's a very wide range of experience on the webinar tonight. So apologies if this is quite a basic level. We're going to try and kind of have content for everybody. But what I want to do is just give a quick introduction really to some different types of investment vehicle. We've got a couple of investment trusts talking tonight, and also we've got some unit trust structures as well talking. And there are a couple of key differences between them. In an OIC or a unit trust, the number of shares is unlimited. The fund can keep on growing. It can keep on issuing new shares, whereas an investment trust has a fixed number of shares. There's also something called an exchange traded fund, which we're not talking about this evening, which is typically associated with passive investing. An investment trust can borrow money to try and enhance the returns or the income that you get from this investment, but that's not really possible within an OIC. So that's quite a key difference between the two. And also the way that income is treated is also different. All of the income generated in an OIC has to be used or paid out to investors in a year, whereas in an investment trust, some of that can be held back for future years to make the smoothing of dividends a little bit easier. As we've seen in recent years, that volatility in the income can make quite a difference. In the valuation, we see an OIC or a unit trust price at net asset value. So they take the value of the assets on a day and divide it by the number of shares that are in issue and give you the price. Whereas an investment trust, a little bit strange, it can actually trade at a value more than its underlying assets, or indeed sometimes less than its underlying assets. An investment trust is listed on the stock market, whereas an OIC or a unit trust isn't. And pricing is quite a key difference here. An OIC or a unit trust is priced once a day, often at 12 noon, and so you buy in advance of knowing the price. Whereas an investment trust is priced throughout the day. So if you want to deal, if the stock market's open, you can buy or sell your investment and you can accept or decline the price that you are offered. Whereas an OIC, it's called forward pricing and you don't know the price that you are buying or selling at there. So some fundamental differences I think that are worth highlighting before we get into a little bit more detail. And what about active and passive investing? You hear lots and lots about this. There's a big debate in the industry about whether passive is better than active or active is better than passive. Tonight, we are focusing on active investing. There are 5 actively managed funds where they're looking to deliver a certain outcome. And that outcome is quite important because when you get to follow a passive strategy, they're simply designed to track the performance of an index. Now, that index might be the FTSE All-Share Index, the largest companies in the UK, or it might be the S&P 500 Index, the largest companies in the US. But the job of that passive investment is simply to track the performance of that index. There's no human element involved at all. No one sat there really selecting, oh, well, I like company A, I don't like company B. It's likely to replicate the index there. And if there's 100 companies in the FTSE 100 Index, it's likely the passive will simply own all 100 companies in the right proportion to track the FTSE 100. So if you own that, you simply go where the market goes. The market goes up, your passive should go up. The market goes down, your passive should go down. It buys you low-cost market exposure. Now, an actively managed strategy is very, very different. The fund manager follows a very particular type of strategy and chooses the investments that they think are best suited to meet that. They're aiming to outperform a specific benchmark or deliver a certain outcome. So it might well be that they're looking to outperform the FTSE All-Share Index, or deliver you a certain amount of income, or deliver you a lower risk return. Could be many, many different things. And the 5 funds you'll hear from tonight all have a slightly different objective, investing in different markets around the world or different asset classes as well. So often in an active fund, the portfolio is positioned quite differently to the index. It can be quite different to the index there. So if we pick an example, let's take Tesco as a company. The fund manager might choose not to own Tesco at all, yet it's a reasonable size position within the FTSE All-Share Index. Or they might like Tesco and choose to own lots of Tesco and be overweight, have more than the index. And it's these differences that will drive the difference in performance of that strategy or that fund. So there is a risk with an active fund that you underperform the benchmark that the manager's trying to outperform, or they don't deliver on the specific outcome that they're trying to follow. But equally, there is the potential for outperformance to do even better than the index there, which is, of course, what the managers are striving to do. But as we'll look at a little bit later, not everybody, it's not possible to outperform the index all of the time, every single year. Now, the cost of active management are higher than passive solutions, and therefore you need to think about that before you make your selection. So what about active solutions? What do I try and do in my team? Head of investment research, we spend our time talking to fund managers, talking and interviewing the managers that you're going to hear from today. It's just some of the people we talk to. And we think that our job and your job when you're researching active managers to potentially choose from, to try and separate the skillful from the lucky. It's actually quite easy to be lucky over short periods of time. It's really, really difficult to be lucky over a long period of time. So you might find some funds outperform over short periods, and then maybe they never outperform again there. So they got lucky on a few stocks or a few countries, but having that performance repeated over long periods of time is much, much harder. And what we want to do is try and find the skillful managers and try and almost avoid the lucky managers. So what do I think the secret of successful investing is? Well, I think it comes down to actually having a good investment process, one that's repeatable. Now, all of the managers you're going to hear from today, in my view, have a very good repeatable investment process. They may even go into what some of that process is in their presentation to you. But if they don't, I would urge you to try and learn a little bit about their investment style, about their investment process before you consider investing in any manager or any fund. Because if you understand this, then you give yourself a really good chance of understanding what the performance profile would look like. So if someone's got a good process, they implement it repeatedly, then I think if they deserve success if they get a good outcome. But you can have a good process, implement it repeatedly, and still get a bad outcome. It doesn't mean you're a bad fund manager. And we live in a world almost where it's kind of a binary. If they're outperforming, they're good, and if they're underperforming, they're bad. And actually, the world of investment's a lot more complicated than that. So if you have a bad process and you get a good outcome, well, that's lucky. And if you have a bad process and you get a bad outcome, well, I think that's kind of just desserts, really. So we look for managers and funds that have a good, repeatable investment process. Now, lots of you, I'm sure, will look at past performance in an investment strategy, and you may use that as a judge of whether you think it's a good performer going forwards. Now, we would caution that approach because, as I said, no one manager has the perfect investment process to outperform in every single calendar year. Now, on this slide here, I've put the excess performance, so that's the outperformance or underperformance, versus the FTSE All-Share of one of the funds you're going to hear from today, Richard Cole's Threadneedle UK Equity Income Fund. And this is simply by calendar year going back the last decade. Now, Richard has clearly done a fantastic job, but it hasn't been perfect. And Richard would be the first to admit, as would all of the fund managers that you listen to tonight, that they haven't got a process, which means they can say to you hand on heart that they expect to outperform every single year. They will go through good periods and they will go through bad periods. And some of that will be down to their process, and some of that will be down because the market's interested in a completely different type of company. Tonight you're going to hear from Baillie Gifford, and they invest in a growth style of company. You're going to hear from Troy, and they invest in higher quality companies. You're going to hear from Artemis, who invest in investment grade corporate bonds, all different types of things. But on this track record here for Richard and Threadneedle, you can see he outperformed for 4 years, fantastic performance, and then he underperformed for 2 years. Now, if you were looking solely at past performance, how many of you would be worried or choose not to invest when you looked at the last 2 years and saw that Richard had underperformed the market by 3% in 2016 and by nearly 6% in 2017? You might be looking at it thinking, oh, I'm not too sure about that fund. Maybe that's not for me. Look at that underperformance. I don't think Richard's a very good fund manager. Now, if you'd made that decision at that point, you would then have missed out on the next 4 years where Richard has outperformed the market again. So sorry to pick on Richard here. He didn't know I was going to pick on him to use this example, but hopefully he likes the example because you can see the importance of thinking long term and not judging your investment decision based on a short period of time where a manager may underperform. Because every single investment that I invest in for my clients here at AJ Bell, every single one of those has had periods of underperformance, but it doesn't make them a bad fund manager, and it doesn't mean you should sell it. It's about understanding the performance that is absolutely crucial. So Warren Buffett, the famous Warren Buffett, I'm sure many of you have heard of, he kind of summed this up in a much neater and more succinct way than I have, which is, in the business world, the rear view mirror is always clearer than the windshield. It's much easier to look backwards than it is to look forwards. But if you want to have a good idea of where you're going, it's pretty important to look out the front of the windscreen rather than the back window. And he's absolutely right when it comes to investing. So what are the key things to understand? I'm racing through my time here. There are some things to think about. You need to understand the different investment styles that different funds have. Some funds invest in growth companies, those companies that are perhaps growing faster than the market. They may not even be profitable right now, but in the long run, those companies look like they might have an ability to really change the world and have some significant profits later on. They might invest in value companies that the market really doesn't like at the moment, whose value is not appreciated by the stock market. They're undervalued, and some kind of catalyst may bring that out. Or higher quality companies, large cap, small cap, all these different styles of investment you need to understand before you invest in these funds. So if you can understand the style, then a good way to do that is to try and understand the manager's investment philosophy and process. Is it well articulated and understandable there? All of the fund managers that you hear from tonight, all of the companies they work for, have got lots of information on their website to help you understand how they invest. What about manager tenure? How experienced is the manager? The managers you hear from tonight are all very experienced. I've invested with them or have been interviewing them for a very long period of time, and we certainly know them well, and they have a lot of experience in how they manage money. What about the team? Is it a team or is it an individual? That's really important to understand before you invest as well. You may want to understand if there's key person risk in that. Fund size is another key issue to think about. Is the fund too small? Is the fund too big? Sometimes funds get too big and it's really tricky for them to move around and buy the type of company that they want to buy. Maybe it challenges liquidity in that. So again, all things you need to think about. Is it genuinely active, or simply does it look like the market? Is it a closet tracker, as we call them? If it's a closet tracker, i.e. they simply invest a little bit like the market, you're probably better off thinking about a passive fund there, because it'll be much cheaper. There's no point buying something that looks like the market and then paying significantly more for it. And therefore, also worth thinking about cost. But cost isn't an absolute, it's not just about an absolute number. It's about, is it expensive or is it good value? What type of investment return are you getting from it? It may be expensive in the kind of grand scheme of things, but if you think it's got a very good chance of delivering significant outperformance, then maybe expensive is better than cheap in that case. Really hard to decide that and find that out, but all of these things are factors to understand while you do your investment research. So What are the kind of things that I've learned over the 20 odd years that I've been researching investments and talking to fund managers? Well, good fund managers do exist, but they are hard to find. There are lots and lots of funds out there, but I would be the first to tell you that there are not a huge amount of great funds out there. There are many very, very average funds. So good fund managers exist, but they're hard to find. And outperforming the market consistently is very difficult. I would suggest any investment that you buy will underperform at some stage. And it doesn't make it a bad investment. It doesn't mean it's broken. You need to understand why it's underperforming and is that underperformance in line with your expectations. A growth manager should underperform when growth is not doing well. A value manager should outperform when value is doing well. So if you understand the points that I made on the previous slide, you've got a much better chance of understanding what good and bad performance should look like. And that should avoid you falling into the trap of buying high and selling low, which sadly we do see a lot of investors falling into that problem. They buy after something's done well and they sell after something's done badly. And of course, that's a pretty destructive way of managing your money. But only invest in an active fund manager when you believe they can outperform their benchmark after fees. If you can't find a manager that you think can do that, simply buy a cheap passive solution, of which there are many out there, and they are very, very low cost. As we've seen on the example, don't rely just on past performance there, because that is not a recipe for telling you what's going to happen into the future. It might be a good way of understanding how a manager invests, but it won't tell you how they will perform going forwards. It's vital to understand how your manager invests before you give them any of your hard-earned money there. It's very painful to learn after you've done that. Oh, I didn't know the manager invested. I didn't know they took so much risk. I didn't know they invested in small caps. I didn't know they invested so much in China. So do your homework. Investment research, it takes work. There's lots of tools that we have to help you do that. Really important to avoid the illusion of diversification. And what I mean by that is you might think you're diversified. You might own maybe 5 or 10 different funds. If they all invest in the same style or the same bit of the market, if they're all growth managers or all value managers, if they're all UK managers, you're not really that diversified. You're exposed to the same themes and therefore the same risks in your portfolio. So trying to think about your portfolio as a jigsaw puzzle and how all the different pieces come together is absolutely vital to give you a really nice, neat portfolio. 1 minute literally on current market volatility. There are many, many issues that are troubling the world right now, and it's very easy to feel like you should be doing something to your portfolio. And right now, the events that are going on, the terrible events that are going on in Ukraine, and I'm sure my heart and all of your hearts go out to the awful things that we're witnessing to the people in Ukraine. That is having a real impact on their lives, and of course that's much bigger than anything we're talking about tonight. But it does impact the economy, the global economy, and the stock market too. And it's testing portfolio construction at many, many levels. You will now be learning whether you do have diversification in your portfolio or not. But it's really, really important to avoid making knee-jerk reactions to what's going on. Reacting to events is not a great way of managing your portfolio there. Often, as I say right at the bottom of the slide here, the decision to do nothing is often a very good decision. But remember, it is a decision in its own right, and it can take a lot of thought to come to the conclusion that not making any changes to your portfolio is the right decision there. So don't lose sight of your long-term objective and your strategy, and think about your risk appetite, and then make decisions around that framework. So just as I sum up, how can AJ Bell help you? We have a raft of different solutions and tools to help you with. You're going to hear from some excellent fund managers tonight that sit on our favorite funds list and our investment trust select list to help you with your investment research. But of course, some of you may not be comfortable picking your own funds, your own investments, and therefore we do also have some tools to help you do that. There's something called the ready-made portfolios, which you'll find lots of information about on our website, which is kind of like a starter kit for your portfolio, is a good way to think about it. Or if you really don't know what to do, but you know you should be investing for the long term, Then we have our AJ Bell funds, which do the asset allocation, the underlying selection in a very low cost manner there. So there's a whole raft of different options for you with information on our website to help you navigate the maze of investments. So just one final thought for me before I hand over to James, and it's a really neat quote from Benjamin Graham. I think he's a very well-renowned investor over many, many years, and it's one that really plays to the whole investor psychology point, which I think is relevant for what's going on in the world right now. The investor's chief problem, even his own worst enemy, is likely to be himself. It's you yourself that are going to be making these decisions. So you really got to make sure that the decisions you make, what you invest in, what changes you make, are based on good, well-researched work, that you've done your homework, and you don't just kind of be bounced around by events in the market, because, say, reacting to events rather than understanding and dealing with those events and making a sound decision on them will not likely be a good financial decision in the long run.